What if the American dream of affordable housing is returning to the very cities that priced out an entire generation? For decades, renters watched prices climb into the stratosphere, turning modest apartments into luxury-priced necessities. But 2026 is witnessing something economists once thought impossible: double-digit rent declines in markets that seemed invincible. Across 8 major U.S. cities, for rent signs are multiplying. Landlords are offering concessions that would have been unthinkable 2 years ago, and renters finally have negotiating power. Yet beneath this apparent relief lurks a darker question about what's really driving these crashes. Are we witnessing a long overdue market correction that will genuinely help struggling renters? Or are these plummeting prices the canary in the coal mine, signaling economic devastation that will ultimately hurt everyone? Before we dive into these 8 cities, hit that subscribe button and drop a comment telling us which city you're watching from. Are you seeing rent prices crash where you live, or are you still being priced out? Let's build a map of what's really happening across America. Number 1. Austin, Texas, the tech exodus turned ghost town. Austin's reputation as America's fastest-growing tech hub created a rental market so overheated that studio apartments were commanding $2,200 monthly by 2023. Now those same units sit vacant at $1,450, and landlords are throwing in 2 months free. The city that welcomed Tesla, Oracle, and thousands of California transplants during the pandemic boom is experiencing something that sounds impossible: a 34% year-over-year decline in median rent prices, with luxury towers in the Domain and downtown districts offering unprecedented incentives just to fill units. Walk through Austin's once bustling tech corridors today, and you'll see what happens when speculative development meets shifting corporate policies. Construction cranes still dot the skyline, completing buildings that may never reach full occupancy at their projected rental rates. The explanation isn't simple. Remote work, which initially drove Austin's explosion, evolved into something more nuanced. Companies that relocated here during 2020-2022 are now implementing return-to-office mandates while simultaneously downsizing their physical footprint, creating a paradox where employees must be in office but fewer offices exist. Meanwhile, developers who broke ground during the boom, anticipating continued exponential growth, delivered approximately 31,000 new apartment units between 2024-2026, flooding a market that's simultaneously losing the high-earning tech workers who could afford premium rents. Property tax increases — Texas has no income tax, so municipalities rely heavily on property taxes — are squeezing landlords who must choose between lowering rent or watching units sit empty while still paying mounting tax bills. Yet here's what's unsettling. Austin's job growth, while slowed, hasn't actually reversed. The city added 47,000 jobs in 2025, respectable by most standards, just not the blistering pace of pandemic years. So why are rents cratering if employment remains positive? Some economists point to overbuilding, pure and simple. The supply surge outpaced even robust demand. Others suggest something more concerning. The jobs being added pay significantly less than the departed tech positions, meaning Austin is experiencing a fundamental shift in its economic composition, trading high-salary tech roles for service and mid-tier positions that can't support the rental prices developers projected. Is this a healthy market correction, or is Austin's identity crisis just beginning? Number 2. Boise, Idaho. Small city, massive miscalculation. Boise became the poster child for pandemic-era migration madness, with rent prices surging 46% between 2020 and 2022 as remote workers discovered they could swap Bay Area apartments for Idaho mountain views. But 2026 is serving a harsh reality check as rents plummet 28% and the locals who were priced out are asking whether they can finally come home. This city of 240,000, never designed to absorb thousands of high-earning transplants, witnessed speculative rental construction that assumed the Zoom boom was permanent, and now those assumptions are being violently corrected. Property management companies that once required proof of income at 3.5 times the rent are now accepting applications at 2.5 times and waiving application fees. Desperate signals in a market where vacancy rates have tripled from their 2022 lows. What broke Boise's rental market? Start with the obvious. Remote work policies reversed. Major employers like Amazon, Google, and financial institutions that initially embraced fully remote arrangements began mandating office returns in 2024-2025, and workers who'd relocated to Boise during the pandemic faced a choice: return to expensive metro areas or find new employment. Hundreds chose the latter initially, but Boise's actual job market, while growing, couldn't absorb tech workers at their previous compensation levels. The city's largest employers are in healthcare, food processing, and state government, sectors that don't typically pay Silicon Valley salaries. Additionally, Boise's pandemic reputation attracted investor speculation. Out-of-state buyers purchased properties to convert into rentals, betting on continued appreciation. But when demand softened, these investor landlords had less attachment to maintaining prices and cut rents aggressively to avoid prolonged vacancies. But here's the paradox that should make everyone uncomfortable. Boise's population is still growing, just not at the explosive rate of 2020-2022. The metro area added approximately 11,000 residents in 2025, yet rents are falling dramatically. In traditional economics, population growth should support rental prices. So what's happening? The composition matters. Boise is losing high earners while gaining mid-income residents, and the rental inventory was sized and priced for the former group. New construction delivered approximately 4,200 apartment units in 2025 alone, roughly one new unit for every 3 new residents, a ratio that would overwhelm most markets. Whether this represents a return to sustainable pricing that locals can actually afford or signals deeper economic instability depends entirely on your perspective and which side of the landlord-tenant divide you occupy.
Number 3. Phoenix, Arizona. Desert mirage evaporating. Phoenix's metropolitan sprawl, which seemed unstoppable as retirees and job seekers flooded the Valley of the Sun, is confronting a rental reality that's making national headlines. 19% year-over-year rent declines in some submarkets, with particularly steep drops in the suburban French communities that exploded during the pandemic. The city that added more residents than almost anywhere in America during 2020-2023 is now watching as landlords in Gilbert, Chandler, and Surprise offer move-in specials, reduced deposits, and rental rates that haven't been this low since 2021. Except now the apartments are newer, suggesting something has fundamentally shifted. Drive through these communities and you'll see the evidence. Rental signs staying up for weeks, apartment leasing offices that were appointment only now welcoming walk-ins, and property managers who suddenly remember that customer service matters when tenants have options. Phoenix's rental correction stems from a perfect storm of overlapping factors. First, the sheer volume of construction. The Phoenix metro area added approximately 44,000 multifamily units in 2024-2025, outpacing household formation even in a high-growth market. Developers, encouraged by pandemic-era population surges, assumed growth rates would continue indefinitely and built accordingly. Second, Arizona's explosive growth attracted residents from everywhere, but particularly from California, and as economic conditions tightened nationally in 2024-2025, some transplants reversed course, unable to find employment matching their previous earnings or simply deciding Phoenix's 115-degree summers weren't worth the supposed savings. Third, the rise in remote work that initially benefited Phoenix is cutting both ways. Workers who moved here for lower costs while maintaining high salaries are now facing return-to-office mandates from employers based elsewhere, forcing difficult choices. Yet, Phoenix isn't experiencing economic collapse by traditional metrics. The metro area added 55,000 jobs in 2025, unemployment remains below the national average, and major employers like Taiwan Semiconductor Manufacturing Company are investing billions in local facilities. So why are rents falling if the economic fundamentals appear sound?
The answer might be that the fundamentals aren't as sound as they appear, or it might be simple supply-demand mechanics working exactly as intended. Healthcare, hospitality, and construction jobs, major drivers of Phoenix's recent employment growth, pay significantly less than the tech and finance positions that some departing residents held. The question haunting Phoenix landlords: were the pandemic-era rental rates ever sustainable, or were they a speculative bubble that's now deflating to levels the local economy can actually support? The verdict depends on whether you believe Phoenix's growth story is temporarily paused or permanently altered. Number 4. Nashville, Tennessee, the music city facing uncomfortable silence. Nashville embodied pandemic-era success: a vibrant music scene, no state income tax, reasonable cost of living, and enough Southern charm to attract 40,000 new residents between 2020-2022. But 2026 is playing a different tune as rents dropped 23% from their peak, and the luxury buildings that sprouted across the Gulch and Music Row struggle to maintain occupancy. The city that marketed itself as the anti-Austin, with better affordability and genuine culture, is discovering that even 650,000 residents can't support the rental inventory that developers assumed would be needed for a metro of 1 million. Landlords who confidently charged $2,400 for one-bedrooms in 2023 are now advertising those same units at $1,850 with incentives, and the psychological shift is palpable. Renters who spent years accepting whatever terms landlords offered are now negotiating, comparing, and walking away. Nashville's rental decline reflects multiple converging pressures. Construction exploded between 2021 and 2024, with downtown and adjacent neighborhoods receiving approximately 18,000 new apartment units, many targeting the premium market with rooftop pools, co-working spaces, and other amenities that justify higher rents, except the sustained demand for such units never materialized at projected levels. The healthcare sector, a major Nashville employer, underwent significant consolidation in 2024-2025, eliminating redundant positions and creating uncertainty among workers who might have otherwise upgraded their living situations. Tourism, vital to Nashville's economy, has recovered from pandemic lows but hasn't exceeded pre-pandemic levels when adjusted for inflation, meaning the service sector jobs supporting much of the rental market aren't generating income growth that would support rising rents. Additionally, Nashville attracted significant investor activity during the boom, with single-family homes purchased for conversion to rentals. But as yields compressed, some investors are exiting, adding inventory to an already oversupplied market. But here's where it gets complicated. Nashville's cultural amenities and business-friendly environment haven't diminished. The city still ranks highly for quality of life, entrepreneurship, and entertainment options. So is the rental crash a market correction bringing prices back to sustainable levels relative to local incomes, or is it an early warning that Nashville's growth story was always dependent on unsustainable migration patterns? Average household income in Nashville sits around $78,000, significantly below the six-figure incomes that many pandemic transplants brought from coastal cities. If those high earners are leaving and the market is reverting to price points that actual Nashville residents can afford, that's a healthy correction. If the departure of high earners signals broader economic weakness, that's a different story entirely. The data can support either narrative, depending on which metrics you're prioritizing and what future you're expecting. Consider these verified data points that reveal the magnitude of what's happening. Austin's apartment vacancy rate stood at 2.8% in December 2022. Today, it's 11.4%, meaning more than 1 in 10 apartments sits empty despite population growth. Phoenix developers delivered enough new apartment units in 2024-2025 to house the equivalent of Boise's entire 2020 population, a construction boom that added 44,000 units in just 2 years. Nashville's median rent-to-income ratio peaked at 38.7% in 2023, meaning the typical renter spent nearly 40% of their income on housing. Financial advisors traditionally recommend 30% as the maximum, and this ratio has now fallen to 31.2%, not primarily because incomes rose, but because rents fell. Boise's investor-owned rental properties, which accounted for just 18% of the single-family home market in 1919, comprise 34% by 2023, nearly doubling the proportion of homes owned by entities rather than occupant owners. And as these investors face squeezed yields, their exit is accelerating price declines. These aren't marginal shifts. They represent fundamental restructuring of rental markets that housed millions of Americans. Number 5. Las Vegas, Nevada. When the house doesn't always win. Las Vegas built its entire identity on taking calculated risks, but the city's landlords are learning that the rental market casino doesn't always pay out. Rents have dropped 21% year over year in some neighborhoods, as the city that welcomed pandemic refugees from California discovers that not everyone wants to stay where summer temperatures regularly exceed 110 degrees, and water security concerns make headlines. The Las Vegas metropolitan area, home to 2.3 million residents, added approximately 22,000 apartment units between 2023-2025, and many of those units are now offering 6 to 8 weeks of free rent, reduced deposits, and flexible lease terms that were unthinkable when the market was tight. Property managers who once conducted mass lease signings with dozens of applicants competing for single units now personalize their pitches, emphasizing amenities and neighborhood features to individuals who have multiple options and know it. Las Vegas's rental situation stems from its unique economic composition and recent development patterns. The pandemic actually strengthened Vegas initially. Remote workers could live in Nevada's tax-free environment while maintaining high incomes from elsewhere. And the return of tourism in 2022-2023 created service sector job growth. However, several factors converged to oversupply the market. First, developers, seeing population growth and low taxes, assumed demand would continue accelerating and built accordingly, not accounting for the fact that much of the pandemic-era growth was one-time arbitrage by people fleeing California. Second, as inflation peaked in 2022-2023, Las Vegas's cost of living advantage diminished. Groceries, utilities, and other expenses rose sharply, eroding the affordability that attracted people initially. Third, climate concerns became increasingly mainstream. 2023-2024 brought record heat and intensifying discourse about Colorado River water allocations, causing some residents to reconsider long-term viability. Yet here's what makes Vegas particularly interesting. Employment is actually strong. The metro added 48,000 jobs in 2025. The resort corridor is thriving with new properties and expansions, and major events like Formula One races demonstrate the city's continued appeal. So why can't the rental market stay strong? The answer lies in the quality and compensation of employment growth. Vegas is adding jobs, but many are in hospitality, retail, and service sectors that pay $35,000 to $55,000 annually, wages that can't support the $1,800 to $2,200 rents that landlords were commanding during the peak. The high-earning remote workers who could afford those rents are departing as companies mandate office returns. What we're potentially witnessing is Vegas reverting to an economy based on its actual employment base, rather than temporarily subsidized by high earners from elsewhere. Whether that's a healthy market correction or a sign of fundamental weakness depends entirely on your time horizon and what you believe about Vegas's long-term economic trajectory. Number 6. Tampa, Florida. Sunshine State, cloudy outlook. Tampa's transformation into a major migration destination seemed unstoppable. Perfect weather, no state income tax, vibrant culture, and a tech sector that was actually growing. But 2026 is delivering uncomfortable truths as rents decline 17% and insurance costs surge, creating a pincer movement that's crushing landlords and potentially offering relief to renters. The metropolitan area that added 150,000 residents between 2020-2023, one of the fastest growth rates in America, is discovering that rapid expansion creates infrastructure strains, insurance nightmares following Hurricane Ian and subsequent storms, property insurance that cost landlords $2,000 annually in 2021 now runs $6,000 to $8,000 or more, forcing landlords to either raise rents and lose tenants or absorb costs and squeeze already tight margins. Many are choosing the latter, effectively subsidizing tenants to maintain occupancy rather than facing extended vacancies in a softening market. Tampa's rental correction is layered with complexity. Insurance costs have skyrocketed following Hurricane Ian in 2022 and subsequent storms. Property insurance that cost landlords $2,000 annually in 2021 now runs $6,000 to $8,000 or more, forcing landlords to either raise rents and lose tenants or absorb costs and squeeze already tight margins. Many are choosing the latter, effectively subsidizing tenants to maintain occupancy rather than facing extended vacancies in a softening market. Tampa's construction delivered approximately 16,000 new apartment units in 2024-2025, substantial inventory for a metro of 3.3 million, particularly when some pandemic transplants are relocating again due to climate concerns, insurance costs, or employer return to office requirements. Florida's political environment, which some residents celebrated, has alienated others, creating a values-based sorting that wasn't a major factor in previous decades. Additionally, remote work's evolution means Tampa's lower cost of living doesn't offset employer locations as effectively as it did in 2021-2022. But Tampa isn't collapsing economically. The metro added 38,000 jobs in 2025. Port activity is strong, tourism is robust, and major employers are maintaining or expanding presence. So, is the rental decline catastrophic or corrective? If you're a renter who was priced out, the decline represents justice, a return to prices that Florida's actual wages can support, rather than artificially inflated rates sustained by temporary remote worker influx. If you're a landlord facing insurance bills that doubled while rents fall, it represents unsustainable economics that might force you to sell. The fascinating aspect, both perspectives are valid simultaneously. Tampa might be experiencing healthy price discovery after an irrational surge, or it might be entering a difficult period where climate risks, insurance costs, and economic realities create a new lower equilibrium that disappoints everyone expecting endless growth. The verdict remains open. Number 7. Raleigh-Durham, North Carolina, the Research Triangle losing its edge. The Research Triangle built a reputation as America's smartest growth story. Prestigious universities, major tech employers, southern affordability, and population growth that seemed recession-proof. But 2026 is testing that narrative as rents drop 16% and the region discovers that even education and tech sectors aren't immune to broader market forces. Durham, Raleigh, and Chapel Hill watched as luxury apartments marketed to researchers, tech workers, and highly compensated professionals proliferated between 2020-2024, assuming the area's brain gain was permanent and accelerating. Those assumptions are now being stress-tested by a market where vacancy rates have doubled, and landlords are competing with tenants with incentives that acknowledge the balance of power has shifted. The triangle that prided itself on stable, sustainable growth is confronting what happens when developer optimism collides with changing economic realities. Raleigh-Durham's rental situation reflects both overbuilding and shifting employment dynamics. The region added approximately 24,000 apartment units between 2023 and 2025, substantial inventory for a metro of 2.1 million, particularly when that inventory targeted the higher end of the market. Major tech employers, including Apple's significant expansion plans, moved forward but scaled back their aggressive hiring projections as economic conditions tightened in 2024-2025, meaning job growth occurred but at a slower pace than developers anticipated when breaking ground years earlier. The area's academic institutions, while stable employers, underwent budget pressures that limited hiring and compensation growth. Additionally, the Research Triangle attracted remote workers during the pandemic, who are now facing return-to-office requirements from employers based elsewhere. And while some found local employment, others relocated again, typically to metros where their employers are actually based. Yet, the triangle's fundamental strengths haven't evaporated. The region consistently ranks among America's most educated metros, major employers maintain significant presence, and quality of life indicators remain strong. So, is the rental decline a crisis or correction? The region's median household income of approximately $82,000 suggests that peak rental prices, often $1,800 to $2,400 for nice two-bedrooms, were stretching affordability limits. If prices are falling to levels that actual Triangle residents can comfortably afford, rather than prices sustained by temporary transplants with coastal salaries, that's arguably healthy. However, if the decline signals that the Triangle is losing its competitive edge in attracting top talent and top employers, that's a different and more concerning story. The data doesn't conclusively support either interpretation yet, which is precisely what makes this moment so uncertain and unsettling for everyone involved.
Number 8. Salt Lake City, Utah. Mountains high, rents falling. Salt Lake City's enviable position, stunning natural beauty, growing tech sector, major university, and outdoor recreation that rivals Colorado made it a pandemic darling as remote workers discovered they could trade expensive metros for Utah's mountains and relatively affordable lifestyle. But 2026 is delivering a harsh reality check as rents drop 20% and the city confronts whether its boom was sustainable or speculative. The metro area that added 40,000 residents between 2020 and 2023 is now watching as apartment buildings that filled immediately just 2 years ago require aggressive marketing, concessions, and rental rates that have dropped below 2022 levels. Property managers who once rejected applicants for minor credit issues are now approving borderline cases and offering flexible terms, a psychological shift that signals markets have turned decisively in renters' favor. Salt Lake's rental correction combines familiar elements with unique local factors. Construction added approximately 14,000 apartment units in 2024-2025, substantial inventory for a metro of 1.3 million. And much of that inventory targeted higher-income renters attracted by the area's tech growth. However, tech hiring nationally slowed dramatically in 2024-2025, and while Salt Lake maintained some growth, it couldn't match the pace that developers anticipated when planning projects years earlier. Remote work's reversal particularly impacted Salt Lake. The city attracted significant numbers of California refugees working remotely, and as return-to-office mandates increased, many faced choices between returning to expensive metros or accepting local employment at lower compensation. Utah's rapid population growth also created infrastructure strains. Traffic congestion worsened, air quality issues intensified, and the laid-back culture that attracted people began eroding, making the trade-offs less appealing. Additionally, housing costs, while lower than coastal metros, rose sharply enough that Salt Lake's affordability advantage diminished relative to comparable western cities. But here's the unsettling question. Salt Lake's economy is actually performing well by traditional metrics. The metro added 25,000 jobs in 2025. Major employers are investing locally, and the outdoor recreation economy, skiing, hiking, biking, continues thriving. So why are rents falling if employment is growing and the city remains attractive? The answer might be simply that supply exceeded demand after years of overbuilding, or it might indicate something more fundamental, that Salt Lake's pricing was always dependent on attracting high-earning transplants rather than being sustainable relative to local wages. Utah's median household income of approximately $79,000 suggests that rents approaching $2,000 for modest two-bedrooms were stretching local affordability. If the market is correcting to levels that Utahns can actually afford, that's healthy price discovery. If it signals that Salt Lake is losing its competitive position and will struggle to attract talent and investment going forward, that's a warning sign. Which interpretation is correct? The uncomfortable answer is that we won't know definitively for several years, by which time decisions made today by landlords, renters, developers, and policymakers will have already determined the outcome.
These final verified numbers reveal the scope of the transformation. Across these 8 cities, approximately 163,000 new apartment units were delivered between 2024 and 2025, equivalent to housing the entire population of a mid-sized city like Eugene, Oregon. Except this inventory landed in markets simultaneously experiencing slowing population growth and remote work reversals. Insurance costs in Tampa and other Florida markets have increased by an average of 180% since 2021, creating a situation where landlords' operating expenses surged by $6,000 to $8,000 per unit annually, even as market rents fell. An impossible squeeze that's forcing investors to reassess entire portfolios. The percentage of rental applications requiring proof of income exceeding 3 times monthly rent, standard practice during the tight market of 2021-2023, has fallen from 87% to 61% across these metros, with many landlords accepting 2.5 times income or less, acknowledging that previous standards would disqualify too many potential tenants. Remote work positioning, which accounted for an estimated 32% of the pandemic-era migration to these cities, is now virtually eliminated as a factor, with only 14% of 2025 relocations to these metros citing remote work as the primary motivation, fundamentally changing the demographic and economic profile of new residents and eliminating a key source of rental demand that sustained peak pricing.
These 8 cities represent a pattern that's simultaneously hopeful and ominous depending on your vantage point. For renters who spent years watching prices spiral beyond reach while landlords held all leverage, the crashes represent justice, markets correcting to levels that actual local incomes can support rather than speculative peaks sustained by temporary forces. For landlords, particularly smaller investors who purchased during the boom, the crashes represent financial devastation, plummeting rents, surging vacancies, increasing operating costs, and mounting losses that could force sales and exits. For local officials and economists, these markets pose uncomfortable questions about sustainable growth, the risks of overbuilding, and whether cities can maintain prosperity when housing markets correct. What's genuinely unsettling is that traditional economic indicators don't clearly predict which interpretation is correct. Most of these cities are adding jobs, maintaining amenities, and avoiding obvious collapse, yet their rental markets are crashing. This disconnect suggests we're witnessing something more complex than simple recession, possibly a fundamental repricing of housing relative to actual wages, rather than temporarily inflated wages of remote workers from expensive metros. The cities that thrived by attracting high earners from elsewhere are discovering what happens when those workers leave and markets revert to pricing based on local employment. Are crashing rents a gift to renters who deserve affordable housing, or an early warning of economic weakness that will eventually hurt everyone? The answer depends on what happens next, whether these cities can build economies strong enough to support their expanded housing inventory with actual local jobs and wages, or whether the pandemic boom was always a speculative bubble that's now deflating painfully. Renters and landlords alike are making high-stakes decisions with incomplete information, and the verdict won't be clear until years from now, when we can look back and understand whether 2026 was the year housing finally became affordable or the year the cracks in the foundation became undeniable. What's happening in your city? Are you seeing these same patterns, or is your rental market defying the trend? Drop a comment below and let's compare notes. And if you found this valuable, consider subscribing. We're tracking these markets monthly to see how this story unfolds. Thanks for watching.